If you look at the details that the ECB released on the anti-fragmentation tool, the ECB wrote that any countries that apply for this program where the ECB would be buying their debt, the applicant cannot have excessive deficits, there can't be severe macroeconomic imbalances in the country, and in the judgment of the European Commission, the nation must be on a sustainable path with its debt. Well, I mean, all of that is ridiculous because it's only the countries that are not on a fiscally sustainable path, that have excess debt. Those are the countries that are going to be applying for the program. So the program itself doesn't make any sense if you're going to deny access to the program to all the countries that need the program. But of course, every country is going to want to avail itself of this program. Otherwise, they're just a sucker. That's the moral hazard implicit in doing something like this. Because if the ECB has to print euros to buy Italian government bonds, then everybody in the Eurozone is going to have to pay the price in terms of higher inflation.
And now with them raising interest rates, inflation continued to skyrocket. What the COVID war did is unprecedented. It's incalculable the damage it's done. It killed the lives and livelihoods of billions of people.
Right.
You mentioned about what's going on in Sri Lanka. How about exactly what you said? You know, it's the New World Disorder. It's going on all over.
Yep.
When people lose everything and they have nothing left to lose, they lose it. And they've lost everything.
We want markets to make sense. If they don't make sense, we should all just hang it up, right? I do think sometimes in our desire to satisfy that cause and effect, we create narratives and we try to find data points that satisfy the narrative. I think sometimes we should try to do that, but sometimes it's difficult. I think right now we're in this period where the worst of the inflation shock is probably behind us. Again, I no crystal ball. I'm just reporting what I read, and just reporting on 9.1% is a very high number. It's going to be hard for the CPI to sustain itself at that level, right? It's like volatility. If the VIX is at 80, the odds are it's going to come down. So there's a mean reversion element here. And I think that the market is sort of satisfied that the Fed has done enough so far, waiting to see where it goes, and then waiting, as you alluded to, Andreas, to see if some of this demand destruction is too much, right? This is why it's going to be so difficult.
That is destructive because we want free markets. Again, we're talking about money supply. We're talking about increases in the money supply and how that mechanically works in the market. Well, part of the money supply is the fucking stock market, guys, right? So like, you want to talk about like the money supply itself. We're adding liquidity to the stock market when we're in a bull run. We're taking liquidity out of the stock market, so that affects the money supply too. So I don't know where we're trying to go with this, because to me, let's like, I like to focus on, how can we, again, if you want to go into these deep dives about how the monetary system works, I think it's really important to do. But what does it mean for us, I think, is, a different question. And right now, we're faced with economy that has too much debt, that the supply chains are definitely out of whack. We need energy investment. Americans are facing very high inflation, historically very high inflation, and we are at very low unemployment numbers, right? So
next week, the Fed is set to raise interest rates 75 basis points. We're going to be up to 2.25 to 2.5. If we were in recession when interest rates were 0.5%, 1%, 1.5%, think about how much worse that recession is going to be when interest rates are higher. And by the way, interest rates aren't just going up in the United States, they're going up all over the world, including in Europe. Because on Thursday, the ECB did something that it hasn't done in 11 years. It hiked interest rates. And in fact, it hiked them by more than the market was expecting. the consensus was that the ECB was going to move by 25 basis points. Instead, it moved by 50 basis points, which means this is the first time in 11 years that interest rates have been above zero in the Eurozone.
Yeah, I mean, again, they're listening to the mainstream. They get they live by sound bites. They're not doing the research to find out the details of what's going on. And you talked about the Chinese communists. How about bringing China into the World Trade Organization by Bill Clinton? Oh, and they came in two weeks officially after 9/11 when nobody was looking. And you look at China's GDP, like from 1970 and then 2001, a straight line up. Oh, and all our jobs that went over to communist China. Oh, the communist China that we used to make fun of, where the people wore masks and they could lock down anything they wanted to do and tell you what to do. Oh, and we're going to follow that path. I'm the mayor, I'm the governor, I'm the senator. We're going to lock you down. The Chinese way, you must obey. Welcome to America.
If we look at the tech sector in relation to what has happened in the macro space over the past 2-3 quarters, then I guess there are a couple of things to note. First of all, the tech sector is extremely high duration intensive, which basically means that the average tech company will expect a cash flow further out in time compared to other sectors of the equity space. And that makes the sector very vulnerable to a repricing of bond yields. And it is essentially the reason, I think, behind the sell-off in tech through Q1 and Q2. Secondly, that also leaves the tech sector vulnerable to further upside surprises in inflation, because inflation is directly linked to the repricing of the yield curve, and therefore by the end of the day, if we look a bit ahead, I continue to see potential downside for the tech sector as a consequence of this vulnerability to interest rate hikes. First,
the big issue is inflation, and again, the economy was artificially injected with all this monetary methadone to keep the money junkies high. Everything should have crashed in 2020 when they locked down most of the country and most of the world.
Right.
And it's just artificially boosted up with record low interest rates and countless trillions of dollars pumped in by the government. And now with inflation, and they kept, lying about it or being stupid, whatever you want to decide. First it was temporary and then it was transitory. They lied about it. You're looking at the EU with what, 8.6% in inflation rate and negative interest rates minus.
Now, the economy was already in recession when the index was still above 50, but now it's going to be in an even deeper recession when we're below 50. But even worse was the service sector index, because the service sector is the bigger part of the U.S. economy. In fact, the manufacturing sector is not nearly as bad. That index came out at 52.3, not as big a reduction from the 52.7 from the prior month. And it was actually a little bit better than estimates because they were looking for a 51.8. But it was the service sector that really tanked. That went down to 47 even from 52.7 in the prior month. The consensus was for 52.3. But when you have a 47 on the services index, you know the U.S. economy is in recession, because the service sector is what everybody looks to power the economy. After all, we're supposedly the service economy. Well, if the service sector is in recession, the economy is in recession.